Luke Lloyd with us, Eddie Ghabour with us. Eddie, you've been talking about this as well, that it wouldn't be a short-lived development. We're getting more signs that you're right, and it might be a while before it gets under control. What do you think?
It's absolutely right. And look, the Fed, they could raise rates 200 basis points next meeting. It's not going to change the inflationary problem with food and rent. And this is why we've been saying they're hiking rates at such a fast pace. They're going to kill the credit markets, in our opinion, and it's just going to make the problem even worse. So, in our opinion, they need to give the markets time to let these rate hikes go into the system, and then you would see inflation go down. But unfortunately, with the CPI number we got, they're going to be very aggressive next week again in raising rates. I think that's a problem. And the biggest problem is the amount of their balance sheet reduction. You have to fact check me on this, but I believe in the first 10 days of this month, their balance sheet dropped over $20 billion. It was only $40 billion in August. So they are accelerating at a fast pace. And you can't increase credit or the rate of interest that fast and not expect things to fall apart.
You know, gentlemen, I spoke a little while ago, Marty Walsh, Labor Secretary, on this apparent deal to avoid a nationwide rail strike. But, you know, when you look at the key components of the deal and some of the generous pay and benefit provisions, don't get me wrong, good for the workers, but I wondered if it was necessarily good for all Americans for whom those costs will probably be passed along. This is from my exchange with Marty Walsh. And Eddie, I'd like to get your thoughts on it after he's done. Take a look. There is something when you talk about people learning a lot, sir, from a negotiation or a settlement. Others might take wind of this and say, well, the rail workers got a 24% pay hike. I want in on that. Are you afraid? Are you worried that will be a trendsetter here?
No, I'm not worried, and I think that workers in America deserve to be paid a fair wage. And I think that when you look at what's going on here, and you look what those workers in the rail and other workers in this country have gone through, they deserve a fair wage. I think anyone
but
watching
this, 24% a fair. I get what you're saying.
24% over 5 years.
The 14% that's retroactive of the last 3 years. The 24% through 2024. That's no matter how you slice it, well beyond the inflation rate.
I don't believe that. I could be wrong, and if I am, I'll come back and apologize. I think it's a 24% increase over a 5-year period.
Okay, technically it is not, but I'll just leave that aside, Eddie. I'm happy for the rail worker, fine. But the other issue then, other unions, private, public, look at that and say, I want that. Do you worry about that?
Absolutely. I mean, that's going to cause a snowball effect. And guess who's going to end up paying the bill for that? It's the consumer. And the consumer has been hit from all angles, you know. And this is just going to add to the inflationary problems that we have. That goes back to my original point that the Fed can't stop some of these things. They're only going to make them worse. So if this trend continues, then the consumer is going to get a knockout punch. And I think we are heading into a global recession. And I think investors need to respect what's happening under the hood from a fiscal perspective and from the bond market and income perspective, because the bond market is giving some crystal clear signals as to where we are heading here in the near future.
Gentlemen, I want to thank you both. And to echo your point, guys, we should note that a 2-year note was in and out of 3.8%. So clearly the markets are higher, not only expectations of higher rates, but still higher rates beyond that, whether it's over the Fed's control or the private markets. We'll have more after this.